Good afternoon, everybody. Welcome to MarketStream.live. My name is Joseph Kizuk with the Kizuk Group, securities offered by Money Block. This is the closing bell. The Fed has spoken. They raised rates quarter of a point, so we're now at 1% on the overnight rate. So those of you that have credit card debt, you're going to be paying more. For those of you that have some interest-bearing accounts on the short-term end of the curve, you might get a little bit more. But the markets, they were anticipating that. What they weren't anticipating was such an aggressive statement and a rollout of how the Fed is going to be unwinding this balance sheet that's full of different bond maturities as well as mortgage-backed securities. And that's what everybody on the institutional side was waiting for. And they came out very aggressive in their statements. They're going to be unwinding this balance sheet into starting almost immediately going into the remainder of this year in 2018. Obviously, they're going to watch the inflation forefront, which is non-existent. But right now, what you're seeing is a market that's holding up. The Dow Jones finished today up 46. The reason why, the top 10 components -2, like the names of like McDonald's, Boeing, Home Depot, Goldman Sachs, some of the most notable names in the Dow Jones, all to the upside. That held up the Dow all day. The S&P 500, a little bit less, finance did hold up a lot better after the interest rate hike. But the market, again, just hanging in there. But the bulls just can't keep a good spoo down, I guess. Bulls continue to hold the upside, as well as the NASDAQ. Was down 24, stayed in this level, but well off of its worst levels of the day, especially after the open. Tech really holding in there right now. We'll see how that transpires tomorrow. The Russell 2000 bounced back from its lows. I have positions for my clients in both the Russell 2000 and in the NASDAQ. And again, watch the small caps. I think that we're going to continue to see, we had CPI data, retail sales, all come out a little bit more disappointing than expected, but still solid. I think there's so many moving parts to this, folks, that cash is a position now. I'm saying that as an advisor. I have positioned a lot of my clients' portfolios in cash. I've talked to them about it, given them my rationale, and we're both on the same page. Now, with that being said, it doesn't mean that I'm going to stay there, and I always fully disclose my positioning with me and my clients. Taking a look at the crude markets, though, the crude markets continue to pull back. And you know what? They're now below 45. I said it last week, and I'll continue to say it. I think this $44 to $45 level is more of a base than anything else. I think after the EIA report this morning, where there was a smaller than expected draw of only 1.1 million barrels, what was interesting, though, that there was a build in the RBOB contract. Now, you might go, RBOB, what is that? Gasoline, folks. If you take a look at the... I'm going to actually type in RB and take a look at the future. The gasoline futures finished down at 143.43. That's down 3.4%. There was a larger build in gasoline stocks of about a little over 2 million barrels of gas. Let's see if that actually impacts what's going at the pump. And again, I can't reiterate this enough. We got to see some demand start flowing in here. The commodity side, specifically on the crude side, there's a glut of inventory. And with seeing CPI lower, retail sales lower, it just means that heightened interest rates is not going to keep the consumer out there spending. And we had talked about this before. We were seeing that the consumer had already shifted their patterns from buying high-end to actually buying generic. So we're seeing the retail look for bargains, look for deals, and so that's why we're not seeing inflation. And with the likes of Amazon's and the competitive low-cost, maybe even big box stores out there that are offering, non-name brand products out there at lower price points, even though revenues have been solid, let's see if that continues. But if the consumer continues to claw back here, which the data is showing that they are, I'm going to be hard-pressed to say that we have a lot of momentum, at least domestically here in the U.S., which is going to put a pressure not only on the consumer discretionary side, but I would also say counter that would be on the small caps in the Russell 2000. The gold contract pulled off pretty considerably today. As a matter of fact, you saw that it basically settled on its lows after the Fed came out with their announcement. All right, let's sell off gold. The dollar fell precipitously as well. As a matter of fact, if we take a look at the dollar index, let's just bring that up right now. I'm going to look at the dollar future. You see that it ended the day down 18 cents. That's good for 96.94 on the dollar. This is, again, a bearish moment for the U.S. dollar. The dollar keeps clawing down. Now, with the fact that the Fed raised rates, but we're seeing lower inflation, let's see if the dollar starts to perk up here in the next couple of days. We also saw a pullback in copper. I said keep an eye on copper. Copper is going to give us a good indication of growth on the material side, specifically areas like infrastructure spend and growth, both here domestically in the United States and globally. If we don't see copper start moving to the upside, and it was down another 1.39% today, and it broke through its 20-day moving average, the short-term bears are starting to take a little bit of control. A break of copper at 248, 249, that's going to be extremely negative for this industrial metal. So keep an eye on that. Taking a look at the bonds finished up big today. The 2-year and the 10-year both finished up in price. That means that yields came down. And here's what's interesting, is we're starting to see that curve between the 2-year and the 10-year is starting to get flatter and flatter. In other words, the difference between the 2-year and the 10-year interest rates, they're starting to get closer to each other. And if that occurs, if they keep raising rates over the next year and a half, and the 10-year is not moving, that's going to be problematic, folks, and we have to watch that. Now, we don't have to all be economists in the room, but the bottom line is that it's going to put pressure in fixed income markets. It's going to put uncertainty into, or potential volatility into the equity markets, because now to get yield on the longer term end of the curve, you're going to have to go into things like equities, like other sectors and segments of the market other than the fixed income markets, because rates aren't moving. That could spur on volatility. Now, we didn't see that today, but it could. And you saw that the latter end of the curve, the 10-year and the 30-year, just really skyrocketed on this news. And on the sentiments of the Fed that they're going to unwind this balance sheet. Remember, they were buying a lot of these bonds. They were buying a lot of these mortgage-backed securities. When these things come to maturity and they're not buying them, who is going to buy them? And especially at these rates, it's going to be very difficult to say. So there is quite a bit of vacillation right now, uncertainty on that. But where that's not showing up is in volatility. As a matter of fact, vol finished up 20 cents at 1060. That does not tell me that there's a lot of fear in this market. As a matter of fact, with the bounce back that we saw in the general indices, we're not seeing it right now. But we'll have to see what kind of follow-through we have tomorrow. The next 2 days could be potentially volatile for one main reason. We have triple witching, actually quad witching, because it's June expiration. So that means that you're going to have June options, June futures, June single stock futures, and so forth, all roll over into the September expiration month as the front month. That means that we could have some potential volatility with these rolls, especially now that the Fed is out of the way. We'll watch the remainder of the week as far as economic data. Also, watch the headlines. The headlines could start impacting. We had the atrocity in Washington today. And again, folks, we have to watch this. And as I said earlier, cash can be a position, so manage it accordingly. If you see opportunities to take profits, you feel uncertain, cash is a position. We'll talk more about how you can manage that, but that could be a viable position at this juncture, especially with markets at all-time highs, but starting to question where the catalysts are going to be. All right, folks, that's it for the closing bell. I want to thank everybody for watching MarketStream.live today. And as always, you can go back and take a look on Facebook at all of our different videos for the day. As you can see, they're all updated live. You're probably watching me live on here. For those of you that do watch us when we're on Facebook Live. And you can always go to the website. You can check out the premium content. It's all free right now, folks. They are going to be charging for some of the tools and services. Go check it out. It's pretty cool stuff. All right, that's it. Have a great night, and we'll see you tomorrow morning.